When we look at the modern financial landscape, we are usually presented with a rigid choice between two distinct paths of wealth. We are told to buy real estate, or we are told to buy stocks. They are presented as opposing forces. Real estate is heavy, physical, and permanent. The stock market is weightless, digital, and constantly in motion. We are taught to view them as entirely different asset classes, with entirely different rules. But when you step back and examine the deep historical record, a much more complex reality emerges. Stocks and real estate appear to be completely different forms of wealth, but throughout history, they have repeatedly converged through ownership, leverage, liquidity, cash flow, law, and human psychology. To truly understand how capital functions, we have to strip away the modern marking and look at the underlying mechanics. We have to investigate how these two systems actually operate under extreme pressure.
Consider a homeowner sitting in a quiet suburban living room on a Tuesday evening. He has just made his final mortgage payment. He holds the deed to the property in a safe upstairs. He feels a profound sense of security. He believes he has achieved absolute ownership of a piece of the earth. In the legal architecture of most modern economies, what he actually holds is a specific legal arrangement known as fee simple ownership. Fee simple is the highest and most complete form of property ownership available to an individual. It gives the homeowner a powerful, broad bundle of rights. He can occupy the home, alter it, sell it, or pass it down to his heirs. But those property rights, while legally powerful, are not absolute. Fee simple ownership remains fundamentally subject to the authority of the sovereign state. It is subject to local zoning regulations that dictate what can be built. It is subject to easements that allow utilities to run through the soil. It is subject to the government's power of eminent domain, which allows the state to seize the property for public use in exchange for fair compensation. And most importantly, it is subject to taxation. If the homeowner ceases to pay the annual property taxes assessed by the local municipality, the government can place a lien on the property and eventually foreclose on the asset to recover the unpaid debt. The physical dirt is permanent, but the legal right to hold it is conditional. It exists within a framework of ongoing financial obligations. And what about the alternative? What about the absolute, frictionless liquidity of the stock market? We are frequently told that equities are a fundamentally superior asset because of their immediate liquidity. If the housing market requires months of negotiations, inspections, and closing periods, the stock market requires only the tap of a screen. We assume that because millions of shares trade hands every day, we hold a mathematical guarantee that we can convert our digital assets into cash the exact moment we need it.
But history demonstrates that market liquidity is conditional, not guaranteed. Look back to the trading floors during the crash of 1929, or the terrifying afternoon of the 1987 flash crash. When severe liquidity stress hits the system, the fundamental mechanics of the market begin to break down. The specialists and market makers, the institutions that normally facilitate smooth trading, step back to protect their own capital. During these moments of extreme psychological panic, spreads can widen dramatically. The gap between what a buyer is willing to pay and what a seller is demanding becomes an undeniable chasm. Market depth can simply disappear. Prices can gap down violently from one trade to the next, bypassing stop-loss orders entirely. Execution becomes extremely difficult, highly unpredictable, or incredibly expensive. In a true financial panic, the highly liquid stock market can suddenly trap investors in a bottleneck of execution. The liquidity was always an emergent property of stable human behavior, and when that behavior turns to blind fear, the exit doors become dangerously narrow. To understand how these two seemingly opposed assets, the heavy physical property and the abstract financial claim, first became intertwined, we have to trace their history back much further than modern Wall Street. Imagine the rushing waters of the Garonne River in Toulouse, France, in the middle of the 13th century. Towering over the riverbanks is a massive, highly complex wooden watermill. Its giant wheels turn relentlessly in the violent current, driving heavy stone gears that grind the local farmers' wheat into flour. This is the Société des Moulins du Bazacle.
A watermill in the 13th century was an incredibly capital-intensive piece of physical infrastructure. It required immense resources to build, and it required constant, expensive maintenance to repair the damage caused by frequent flooding. It was too massive of a financial undertaking for any single merchant to hold alone. To solve this problem of capital formation, the local businessmen did something highly innovative. They took this physical, productive piece of real estate and they divided the ownership of the mill into 96 fractional shares, known as ucho. This stands as one of the earliest documented examples of fractional tradable ownership.
If you purchased an usho, you did not have to stand in the damp mill and carry sacks of grain. You simply held a financial claim that entitled you to a percentage of the mill's grain grinding profits. And because the profits fluctuated based on the river's flow and the local harvest, the value of the shares fluctuated on the open market. Centuries before the Dutch East India Company launched its ships, the citizens of Toulouse were trading financial claims based directly on the cash flow of a physical real estate asset. The two worlds were born from the exact same need to share risk and reward. As centuries passed, the trading of financial claims expanded beyond physical mills and trading voyages, evolving into the complex global stock markets of the 20th century. But as the markets grew, they ran into a severe physical limitation. By the summer of 1968, the American stock market was facing a catastrophic structural crisis. Trading volumes had surged heavily, frequently pushing past 12 to 15 million shares a day. The post-war economic boom had brought millions of new investors into the market. But the settlement infrastructure of Wall Street was essentially a 19th century postal service trying to process a 20th century economic boom. Every time a share was bought or sold, a physical paper stock certificate had to be located, manually verified, signed, and physically transported across Lower Manhattan by a human messenger. The brokerage firms were suffocating under literal mountains of paper. The back offices fell hopelessly behind. Fails to deliver, transactions where the seller's broker could not produce the physical certificate to hand to the buyer's broker soared into the billions of dollars. The chaos became so severe that organized crime syndicates infiltrated the overwhelmed mailrooms, realizing they could simply walk away with untraceable bearer bonds and negotiable certificates lost in the operational blizzard. The situation reached a breaking point. For the entire second half of 1968, the New York Stock Exchange was forced to close its trading floor every single Wednesday, simply to give the exhausted clerks time to dig through the backlog of paper.
This crisis forced the creation of the Depository Trust and Clearing Corporation. The industry realized that the physical process could no longer handle modern trading volume. The financial system became increasingly dependent on digital records, immobilizing the paper certificates in centralized vaults and replacing physical transfer with electronic bookkeeping. The stock market had to shed its physical weight in order to survive its own scale. But while the stock market was discovering the limits of physical paper, the real estate market had long been teaching investors brutal lessons about the limits of physical land. Consider the fate of Robert Morris. In the late 18th century, he was one of the wealthiest men in America, a founding father and a brilliant financier who had personally helped fund the American Revolution. He was highly adept at navigating early credit markets. But in the 1790s, Morris shifted his vast fortune into massive land speculation. He formed the North American Land Company and purchased millions of acres of undeveloped territory across the expanding United States. The theory of land speculation seems mathematically simple. Population grows, land is finite, therefore the value must increase. But Morris's strategy ignored the harsh economic realities of the asset class. Real estate can be highly illiquid. It cannot be sold in fractions on an exchange to raise emergency capital. Furthermore, holding undeveloped land requires carrying costs, including taxes and maintenance, that drain cash flow while the investor waits for a buyer. When European credit markets suddenly tightened during the Panic of 1796, the pool of buyers with access to capital evaporated. Morris was left holding millions of acres of illiquid dirt. The massive leverage he had used to acquire the land turned his portfolio into a crushing financial liability. The most sophisticated financial mind of his generation was bankrupted by carrying costs and debt, eventually spending over 3 years in a debtor's prison.
The danger of speculative real estate leverage would reappear repeatedly throughout history,
often causing systemic damage long before the stock market registered the pain. Look to the Florida land boom of the 1920s. Years before the Wall Street crash of 1929 became the symbol of the Great Depression, a massive speculative bubble had taken hold in the swamps of Miami and Jacksonville. Investors from across the country were pouring capital into completely undeveloped Florida real estate, often buying and flipping contracts for land they had never seen, driven by the belief that prices could only move upward. Among the opportunists attempting to capitalize on the frenzy was Charles Ponzi. Having previously been convicted for his infamous postal reply coupon scheme, Ponzi relocated to Florida and established a company called the Charpon Land Syndicate. He purchased tracts of land, some of which were literally underwater, and attempted to subdivide and sell them to investors at astronomical markups, fully participating in the localized hysteria. The Florida bubble was driven by extreme leverage and an overextension of local bank credit. When a devastating hurricane struck Miami in 1926, physically destroying much of the new development, the psychological illusion of perpetual growth shattered. The buyers vanished. The land became illiquid. The subsequent wave of defaults wiped out the regional banking system, triggering a severe localized economic collapse a full 3 years before the broader equity markets would follow suit. The real estate market had demonstrated its capacity for immense volatility, heavily exacerbated by the structure of the debt used to finance it. To fully grasp the relationship between real estate and debt, we must look at how the mechanics of housing finance have been fundamentally altered by federal intervention. Today, we view the 30-year fixed-rate mortgage as the natural, default mechanism for buying a home. We build financial plans around its predictable, amortizing monthly payments. But before the 1930s, this instrument did not exist. Historically, home mortgages were typically short-term, interest-only loans, often lasting 3 to 5 years. A homeowner would pay only the interest for the duration of the term, and on the final date, the entire principal balance would be due as a single massive balloon payment.
In a stable economy, the homeowner would simply return to the bank and refinance the loan for another 5 years. It was a functional system as long as credit was flowing. But during the Great Depression, the credit markets froze completely. Banks, facing runs and insolvency, simply refused to refinance the balloon payments. Millions of homeowners suddenly found themselves owing the entire value of their homes in a single lump sum during a period of massive unemployment. The resulting wave of defaults created a devastating foreclosure crisis that threatened to completely collapse the national housing market. In response, the federal government intervened. Through the creation of the Homeowners Loan Corporation and later the Federal Housing Administration, federal housing reforms were designed to stabilize homeowners and lenders. By extending loan terms to 20 or 30 years and fully amortizing the principal into the monthly payments, the government sought to drastically reduce refinancing risk and make mortgage payments more predictable. The modern stability of the housing market is deeply indebted to this structural shift in how debt is organized. Interestingly, financial history shows us that the stock market also developed distinct vehicles specifically to protect everyday people from the fallout of localized real estate and credit collapses. In 1772, Europe was hit by a severe credit crisis. A wave of banking failures, heavily driven by over-leveraged colonial plantation debt and speculative lending, wiped out the savings of countless citizens in Amsterdam. Watching the financial devastation of smaller investors who had their wealth concentrated in single localized assets, a Dutch merchant named Abraham van Ketwich recognized a structural vulnerability. Wealthy merchants could survive these localized shocks because their capital was spread across dozens of different investments. Small investors could not. In 1774, Van Ketwich created a financial trust named Eendracht maakt macht, which translates to Unity creates strength. He pooled the money of numerous smaller investors to purchase a diversified portfolio of European government bonds, colonial infrastructure debt, and bank paper. This vehicle is widely regarded by financial historians as the earliest mutual fund. It was not born from a desire to aggressively outperform the market, but from a fundamental need for diversification and risk reduction in the wake of a localized credit collapse.
Yet, even with diversified portfolios, the fundamental difference between owning a financial claim and owning physical property remains stark. That difference lies in the real-world friction of physical assets. Picture the streets of Chicago in the winter of 1931. As the Great Depression deepened, thousands of unemployed tenants found themselves entirely unable to pay their rent. In response to mounting evictions, grassroots organizations and neighborhood groups began to actively organize rent strikes. When city marshals arrived to enforce eviction orders and remove furniture from apartments, they were frequently met by massive crowds of organized neighbors who would physically block the doorways or simply carry the evicted family's belongings right back inside the building the moment the authorities left. This historical event underscores a vital distinction. Physical assets create physical social consequences that financial assets do not. When a corporation goes bankrupt, a shareholder loses their capital and the stock ticker goes dark. The loss is contained within the ledger. But real estate involves shelter. It involves the biological and social necessity of human habitation. A residential property portfolio is inextricably linked to the economic realities of the people living inside it. When the broader economy fails, the landlord does not simply experience a decline in asset value. They experience the friction, the legal battles, and the social volatility of managing human beings under extreme financial distress. Under certain conditions, the carrying costs of real estate can become so severe that the physical asset actually takes on negative economic value. Consider the case study of the South Bronx in the 1970s. New York City was experiencing a severe fiscal crisis, population decline, and rampant inflation. Many landlords in the South Bronx were caught in a brutal mathematical trap. The local government maintained strict rent control policies that capped the amount of revenue a landlord could generate. Simultaneously, the costs of municipal property taxes, basic building maintenance, and particularly the cost of heating oil were rising exponentially.
Eventually, a threshold was crossed. For many buildings, the mandatory operating costs, taxes, and utility bills vastly exceeded the maximum possible rental income. The properties were bleeding cash every single month. They could not be sold because no rational investor would purchase an asset with a guaranteed negative cash flow. The financial liability became so overwhelming that many landlords made the calculated decision to simply abandon their buildings. They walked away, leaving the properties to fall into disrepair until the city eventually seized them through in rem tax foreclosures. It is a stark reminder that while a stock can fall to zero, it will never require you to pay for a new roof, and it will never consume your external cash flow simply to exist. But we must be careful not to view stocks and real estate as two completely isolated arenas. Throughout modern history, they have frequently bled into one another, creating massive, deeply interconnected financial cycles. Look at the Japanese asset bubble of the 1980s. During this period, the value of land in prime areas of Tokyo soared to astronomical, unprecedented heights. But this real estate boom did not stay confined to the housing market. It fundamentally altered the Japanese stock market. Japanese corporations realized that the land sitting beneath their factories and office buildings had become incredibly valuable collateral. They used this real estate collateral to borrow massive sums of capital from the banking sector. And rather than investing all of that borrowed capital back into their core manufacturing businesses, they frequently used it to purchase equities in the stock market, often buying shares of other companies doing the exact same thing. This created a massive feedback loop. Rising land values enabled more corporate borrowing, which fueled aggressive equity purchases, which drove the stock market higher, which further strengthened corporate balance sheets. When the Bank of Japan eventually raised interest rates to cool the economy, the land values began to fall. The collateral underpinning the corporate borrowing shrank, forcing corporations to sell off their equity holdings to cover their debts. The intertwined nature of the real estate and stock markets meant that the deflation of the land bubble directly contributed to the historic crash of the Nikkei index. The lines between the two asset classes had blurred into a single architecture of financial interconnectedness. Even within the United States, the fundamental way the stock market generates returns has evolved in ways that spark intense debate about capital allocation. For much of the 20th century, purchasing a blue-chip stock was conceptually similar to purchasing a rental property. The primary appeal was the regular, predictable cash flow generated by corporate dividends. But the mechanics of shareholder returns shifted significantly following the adoption of SEC Rule 10b-18 in 1982. Prior to this rule,
Corporations that wanted to repurchase their own shares on the open market faced significant regulatory ambiguity regarding anti-fraud and market manipulation statutes. Rule 10b-18 created a clearer legal framework, providing a safe harbor for issuer repurchases, provided the company adhered to specific conditions regarding the manner, timing, price, and volume of the trades. Over the subsequent decades, open market share buybacks grew to become an increasingly important method for corporations to return capital to shareholders. The rise of the buyback era remains a subject of intense financial debate. Proponents argue that buybacks are a highly efficient, tax-advantaged way to return excess cash to investors, allowing the market to reallocate that capital to faster-growing sectors of the economy. They argue it is a sign of disciplined management, returning funds when internal investment opportunities are scarce.
Critics, however, argue that heavy reliance on buybacks can be used to artificially inflate earnings per share metrics, tying executive compensation to short-term stock price movements rather than long-term value creation. They express concern that capital spent on repurchasing shares is capital diverted from research, development, employee wages, and the long-term resilience of the underlying business. Regardless of the debate, the shift fundamentally altered the psychology of the equity investor, moving the focus away from dividend yields and toward total return through capital appreciation. When we tried to definitively settle the debate over which asset class is historically superior, we run into the complex reality of long-term data. Consider the work of Dutch economist Piet Eickholtz, who constructed the Herengracht Index. By meticulously digging through centuries of tax records and transaction deeds, Eickholtz tracked the prices of houses on one specific, highly desirable canal in Amsterdam from 1628 all the way to the modern era. When examining this specific, highly localized dataset, a fascinating historical baseline emerges. Adjusted for inflation, the long-term real annual return of these prime properties over nearly 4 centuries is remarkably modest. The data suggests that over multi-century horizons, prime real estate has functioned exceptionally well as a preserver of capital and purchasing power, surviving wars, plagues, and industrial revolutions, rather than acting as an engine of continuous exponential compounding. To gain a broader macroeconomic perspective, we can look to the comprehensive 2015 study conducted by a team of economists titled The Rate of Return on Everything. The researchers compiled an unprecedented historical dataset tracking the total returns, combining both income yields and capital gains, across 16 advanced economies from 1870 to 2015. Their findings disrupt many of our casual assumptions. The data revealed that over this 145-year period, housing and equities actually generated remarkably similar aggregate long-run returns. However, they achieved those returns through very different behavioral paths. In these specific historical datasets, housing generally demonstrated lower historical volatility compared to the sharp, rapid drawdowns frequently experienced in the equity markets. But that lower volatility comes with a significant trade-off. Real estate carries a massive illiquidity premium. It requires ongoing carrying costs, maintenance, and active management, whereas a diversified equity portfolio can be held passively with near-instant liquidity during normal market conditions. When you synthesize the long, complex history of these two financial instruments, the traditional debate begins to look entirely misguided. Stocks and real estate are simply different legal claims on future economic value. Real estate gives an investor exposure to physical land, the fundamental human need for shelter, the collection of rents, demographic growth, and the unique mechanics of mortgage financing. Stocks give an investor exposure to corporate earnings, intellectual property, global cash flows, technological innovation, and the capital allocation decisions of executive boards. Both asset classes are deeply dependent on the stability of property law, the availability of bank credit, the mechanics of market liquidity, the unpredictability of human behavior, and the broader macroeconomic environment. Neither asset is inherently safe. Neither is inherently superior. The real question an investor must ask is not which asset is better, but rather, what specific risks are you actually being paid to take?
You can hold the deed to a physical building, or you can hold a digital claim on a global corporation. The deeper difference between them is not simply physical versus digital, The difference lies in understanding exactly what you own, how it generates value, how liquid it truly is, how much debt supports it, and what happens to your capital when the global economy stops cooperating. The market does not reward blind loyalty to a single asset class. It rewards those who understand the mechanics of the risks they choose to carry.